Gena, thanks so much for taking the time today. We're really excited to have you on the podcast. I think this is a topic a lot of our guests are going to, or a lot of our listeners are going to find value from. Yeah, why don't we kick it off? Tell us a little bit about your background and what you're up to these days.
Great. Thanks so much. Great to be here. My name is Gena Dirani, and I work at a compliance consulting firm called Salus GRC. And we essentially help all SEC registered investment advisors, both new registrants and existing registrants, with their compliance program requirements. So I myself am an attorney by training, and I've worked in the compliance space for the last 10 years, both at other compliance consulting firms and in-house at private equity shops. And in recent years, my focus has been on digital asset compliance for SEC registered investment advisors.
Fantastic. That's great, Gena. Obviously, this is a topic that many are interested in from a digital asset perspective. Just love to kind of hear your take on where we're at today with digital assets, jumping into, obviously, there's a lot of things happening in the space, both regulatory, politically, wherever you want to go with that. Love to hear kind of your take where we're at today.
Right. Yeah, definitely a hot topic indeed. So we're seeing crypto and digital assets rapidly move from sort of niche investments to more mainstream financial instruments. And obviously, this is gaining significant traction amongst institutional investors. And we've seen this through the recent Bitcoin and Ethereum spot ETF approvals, an increase in new registrants with crypto and crypto adjacent strategies, the increasing prevalence of tokenization, et cetera. So this shift is not only transforming traditional finance, but also influencing major political arenas, including our presidential campaign, where digital assets are being discussed as key economic issues for the first time. And we saw comments coming out of the recent Bitcoin conference in Nashville from both RFK Jr. and Trump, notably around a national Bitcoin stockpile. So I think as these technologies become more entrenched in our financial system and go more mainstream, this inevitably will attract greater regulatory interest and scrutiny. And obviously, we're all still sort of waiting for a clear regulatory framework from the SEC, which is likely to come, given I think it was $158 million budget request for 2025 to address crypto complexities. It is sure to come. But in the interim, while we await this SEC framework, it's crucial for advisors to operate under the existing regulatory guidelines and adhere to compliance best practices. So I think today we'll explore some of the key issues that have surfaced in various SEC enforcement actions, exam document request lists, their priorities, risk alerts, et cetera, and sort of go through some of those compliance tips and tricks.
Absolutely. Awesome. Well, I guess to kind of get into it, why don't we talk about the regulatory side of things, kind of interactions with regulators as a fund manager. What are some of the interactions you could expect to have with, or some of these funds could expect to have with regulators that you frequently see or that you might come across?
Right. So they can do sweeps, they can do light touches, they can do full-blown SEC regulatory exams. And I think sort of the common thing throughout all these different formats is to understand how best to interact with a regulator. And one of the most impactful comments on communicating with regulators that I heard at an industry conference earlier this year was an emphasis on the crypto community sort of slowing down and using simpler words and more simplified concepts rather than industry jargon when speaking to people with traditional finance backgrounds, including regulators, in order to help sort of merge the traditional finance and crypto communities. So the SEC's 2024 examination priorities noted crypto as a risk area that will continue to be focused on, along with the risks associated with the use of blockchain technology. And I think that it's very prudent for advisors, both new and established, that utilize these technologies to sort of have a plan in place for not so much if they're examined, but when they're examined by the SEC. And ideally, you'll have gone through, or advisors have gone through, a little bit of a dry run, so they're not doing that for the first time during an actual SEC exam. So having some basic information on hand and already prepared is a great way to avoid examination panic. And we can talk more about the details of that and what that looks like. But what we're also seeing as compliance consultants is a big uptick in the demand for mock SEC exams, as advisors are seeing the advantage to not only the practice of going through an exam from a document pulling perspective, but also the exercise of applying and explaining their very non-traditional, more complex concepts in a practical and simplified manner that a regulator can understand during the examination interview process. Because crypto advisors really can't wiggle out of deficiencies or explanations by saying the regulator just doesn't understand our business. The SEC has a very flexible body of law that we've seen them attempt to impose via enforcement. So really, the point is the SEC won't adapt to the advisor. The advisor really needs to adapt to the regulators. So what does this mean sort of practically? As I mentioned, having some prepared materials on hand, something that we like to call a simplified day one deck. So this is basically meant to sort of cover off some of the information that the SEC would typically request during an initial document request, and that they would want to know up front. So firm overview. How are you organized? How many offices? How many employees? Where do they sit? What do you invest in? What's your strategy? Are you a liquid tokens fund, or are you investing in venture and PE and crypto adjacent companies? Is it a hybrid? Make it easy for the regulators to understand upfront what you do, rather than sort of breadcrumbing them with piecemeal information and having them guess. Make it simple, make it palatable, make it practical for them. Again, from a compliance perspective, highlight for them off the bat what your compliance policies are in the different code of ethics policies that you have in place. What's your personal trading policy? Demonstrate to them up front that it's not, off the shelf, but it's actually bespoke and appropriate for your strategy. For example, if you're liquid, you probably should have a more restrictive employee personal trading policy than if you're not. So showcase those good compliance controls that you have up front, so the examiner doesn't need to go digging and make assumptions. And then, again, as I mentioned, another great way to sort of prepare is to undergo a mock exam. That way, everybody has the benefit of having gone through the process, not in real time, but sort of ahead of time, because there's really a lot of prep that goes into interacting with the regulator. There's an art to answering their questions thoroughly but succinctly without opening up other areas to unnecessary scrutiny. Does everybody know the personal trading thresholds? Does everybody know the Gibson Entertainment pre-clearance threshold? Do people reveal their outside business activities during an interview with an examiner that you don't have logged in your compliance files? And now you have a new unknown potential conflict of interest that you have to examine. So a lot of the information comes out during these personal interviews. So it's really sort of great to get everybody prepped on what that looks like ahead of time.
Yeah,
Absolutely.
that makes a lot of sense. When do regulators when does the SEC want to come knocking on your door? Are there specific things that they're looking for? Without getting too far in the weeds, are there things that set them off? Is there just do they come, they need to do an exam every couple years, or kind of what does that aspect look like?
So it sort of depends. There definitely is a new registrant initiative. So a brand new registrant, I believe, has something like a 50% chance of being examined within the first 12 to 18 months of their registration having become effective. But we've also seen that happen as early as 6 months. So it can be kind of a crapshoot. But definitely the SEC is making a huge effort to basically visit all new registrants within the first year of their registration. So there's definitely that initiative. They could get tipped off about something at a particular firm, and that might lead them to want to examine an investment advisor, or it's just part of their different focus areas where they're doing sweeps on different topics. So it really is pretty variable. But advisors should really be prepared for the SEC to kind of come in and look at everything from top to
That
bottom.
makes a lot of sense.
Mhm.
Mock exam preparation obviously is very important. It prepares your client for potential what they're going to go through. I'm curious, any actual deficiencies that you're seeing as trends, or can be all over the board? I'm just curious.
I think it can be all over the board. Oftentimes, incomplete documentation is a big issue. So, not maintaining all of the required records as part of the books and records rule, not having them easily accessible, that's sort of low hanging fruit that you always want to have buttoned up. You always want to have your code of ethics documentation buttoned up. Vendor due diligence is obviously a hot button issue. So, making sure that you have initial and ongoing vendor due diligence documented for your vendors, particularly around custodians. And as we get into custody more and talk about custody more, I think of crypto custody into 3 different buckets. So qualified custodian with a big Q, qualified custodian with a little q, and obviously self-custody. So again, even when you're dealing with these centralized exchanges, they can obviously go bad, and things can go wrong, i.e. Binance. So you really want to demonstrate that whether it's your custodians or exchanges or counterparties or whomever it is, that you have the documentation to evidence that the decision that you made to interact with that counterparty was reasonable and appropriate at the time, and also continually on an ongoing basis as well. So you want to refresh that vendor due diligence and make sure that you're keeping up with it, at least annually, but perhaps more frequently given the sort of risk parameters or risk temperature of the counterparty, which again can be quite variable.
Right. Makes a lot of sense. Just the length of time from an SEC exam perspective, what are your thoughts as you prepare your clients through this process?
So typically advisors might receive a call from the SEC saying, hey, we're planning on examining you. We're planning on coming in. They might ask for a couple of documents up front. They've probably already looked at your ADV, parts 1 and part 2A that are filed online and obviously regulator and client facing. So that's something that they'll probably scope out before they even come in. So they'll generally give advisors a call, let them know that they're coming in. Again, unless it's sort of an exam for cause and they're trying to sneak attack. And then they'll probably send you a document request list, and they generally give about 2 weeks to turn all of the documents in. Requests can be, sort of really short, like a new registrant exam, and sometimes we've seen them as short as 10 questions, or we typically see them to be about 40 to 65 document requests. Again, about that 2-week timeline to turn around docs, which is honestly pretty difficult to do if an advisor has never gone through the exercise before, which is why the mocks are so important. And then they can spend a couple of weeks, a couple of months reviewing documents. They can come in and interview people. That may often lead them to send a supplemental request, and that can go on, depending on what they find, or it can close out pretty quickly. So it's pretty variable.
That makes sense. Yeah.
Absolutely.
Yeah. I know you brought through kind of this conversation, obviously the custody aspects there. And obviously you mentioned a few different aspects of differences, big Q versus small Q as far as custody goes. I'd love to maybe we can get into that, define what those different terms are for the audience and how we can get into some of the specifics and how it applies here.
So all of this with the caveat that there obviously is a new proposed safeguarding rule out there that would significantly sort of, if adopted as written, would significantly change sort of the environment with which the crypto managers operate from a custody perspective and would require some significant overhaul. But for the most part, qualified custodians, again, with a big Q, are typically those institutions that meet the SEC's definition of qualified custodian, like banks, broker-dealers, state-chartered trust companies, although there's a little bit of nuance there, and others. So think Coinbase and Anchorage for this category. And qualified custodians with a little q are other third-party security and or custody services that offer storage of cryptocurrencies on blockchain, but don't meet the definition of the SEC's qualified custodian with a big Q. So again, when evaluating qualified custodians, big Q or little q, it is important to demonstrate that you've conducted your vendor due diligence. You understand their technological capabilities. How do they actually keep custody? What are they doing to prevent against cyber attacks and fraud? Do they have SOC reports? Are the client assets bankruptcy remote? You really want to make sure that you consider those questions when dealing with your custodian. And there's also the question of insurance and liability. are losses insured, which ones are, which ones aren't, because again, there's a very unique operational risk with crypto in the sense that the same remedies are not available for loss or fraud as they are for more traditional transactions. If you wire money to an incorrect address, or someone steals your credit card or gains access to your bank account, you have some readily available remedies. With crypto, there's a much lower opportunity for recovery, and distinct to crypto too, potentially, is that recovery could be in dollar denominated value rather than in-kind classification, which again could result in significant loss.
Yeah.
So those are, really things to consider when dealing with obviously third-party custodians, but also when you self-custody your own assets as
Right.
well.
Hot and cold storage, all those things. Yeah. Okay.
Exactly. Exactly. If you are self-custodying, you really want to make sure that you have appropriate controls. And, let's say you've got a hard wallet, physical wallet that you can hold in your hand. You want to make sure that you're storing that somewhere safe, like a safety deposit box at a third-party location, for example, not under your bed. There should be at least 2 people with access that aren't in the same location permanently. Again, so you're kind of applying these key traditional concepts like key man provisions and wire transfer and cash movement controls, but to your self-custody solutions. So that's, there's a lot of state-of-the-art custody solutions out there. So as an advisor, you really want to avail yourself of those technologies available to make sure that even though you're using a non-traditional mechanism, that you are able to demonstrate and defend your practice to a regulator that clients' assets are in fact being safeguarded in a reasonable and adequate way. So break up keys, break up permissions, do your due diligence on third-party custodians. And again, make sure you have all of that documented and that your policies clearly articulate sort of what you do for each one of these different custodial solutions, because you don't want a regulator to come in and see that you've got all these really great policies, but you're not actually following them in practice. So again, this audit trail is very
Yeah,
important.
I would imagine even just the size of the manager too, talking about key man risk, can be more impactful if you're only 2 to 4 person shop and you're trying to kind of mitigate a lot of this. It could be interesting, right?
Right.
Yeah.
Yeah. So, you have your multi-party computation wallets and dividing up, the seed phrase and all of that, so that not everybody has access to it. So there's, like I said, there are lots of solutions now to assist advisors with safeguarding assets.
Let's kind of dive into like personal trading. What are some of the rules that apply to these, folks working in a fund when it comes to the personal trading side of things?
Yeah. Okay. So the biggest issues are really making sure that you have bumpers around people trading on inside information, and obviously front running the fund. And the Code of Ethics rule requires that employees report personal securities transactions on a quarterly basis. So that's just something that everybody that's registered with the NCC has to do. And there's a lot of, I get a lot of questions from crypto advisors saying, yeah, but not all these cryptocurrencies should be categorized as securities. So do our employees really have to pre-clear their transactions? And the answer is, yes, because you're still bound by that broader fiduciary duty concept. So, you still are obligated to turn in your quarterly transaction reports. So the majority of advisors that we see tend to require pre-clearance of all digital assets besides Bitcoin and Ethereum, as it's generally reviewed that the market caps of those 2 tokens are too big to be influenced by individual trading activity. But again, now what if you're Mr. 100 and you're buying 100 Bitcoin a day for months at a time? Obviously, if you work at a fund, that could be problematic. I imagine he's not working there. But employees should not impact the price that the client or the fund achieves by moving the market against the fund. So again, that's just going back to that fiduciary duty concept and sort of giving a sort of a long shot scenario, but I think it's a good application of the concept. But basically, the more liquid a strategy, the more restrictive your personal trading policy should be. So, let's say you've figured out which cryptocurrencies are subject to your pre-clearance requirements and which aren't. But let's say you have different legs of a transaction. If you want to trade a non-excluded cryptocurrency into an excluded cryptocurrency or vice versa, what does that look like? So I guess what that means practically is, for this example, again, let's say that you have to pre-clear all cryptocurrencies besides Bitcoin and Ethereum. So let's say you're selling or you're converting Solana into Polkadot. Each of those legs need to be pre-cleared because they're both cryptocurrencies that require pre-clearance. But let's say you're using USDT to buy Ethereum. You don't need to pre-clear either one of those because stablecoins typically, that stablecoin in particular and Bitcoin and Ethereum are typically excluded. But let's say you're selling or converting your Solana into ETH. Only the Solana leg needs to be pre-cleared. But these are the types of nuances that advisors have to be mindful of in their personal trading policies that can often cause sort of these easy infractions that regulators might be looking for when reviewing employee personal trading activities.
Yeah.
So that's something to keep in mind. And a lot of times CCOs will come to me and say, but my employees, they don't want to disclose their wallets. They don't want senior management to know what's in their wallet or how much they have. They're concerned that they're not going to get paid the bonus that they think they deserve if senior management finds out about their digital asset holdings. And, that can't be a reason why you're not collecting employee wallets, for example, and monitoring transactions. So what you can do is basically keep all that information really locked down, anonymized as much as possible, but really kept mainly to the CCO. And I've had advisors go so far as even to keep a log of any time anybody other than the CCO actually takes a look at that employee material. So again, I understand that there are different privacy concerns that are prevalent in this digital asset world. But again, we still have to apply these traditional rules to this new asset class.
Yeah, that makes a lot of sense. That's good insight. Obviously, trying to get a permission process with the CCO. Yeah, and that happens in the traditional setting as well, right? So that makes a lot of sense.
Mhm. Yeah. And, there are a lot of technological solutions out there that help with sort of automated monitoring rather than, manually or collecting this information in paper. But again, going back to that vendor due diligence concept that applies for traditional fund managers and for crypto managers, think about the type of access to information these automated code of ethics monitoring tools have. They have all of your employees' brokerage account and wallet information. So again, going back to that concept of vendor due diligence, it's really vital to make sure that you're diligencing all the different kinds of vendors that you utilize, especially those that have access to really sensitive information like brokerage accounts and wallet addresses. And, there was also concern from a client about the identity of a person being matched to their wallet address, and that they were legitimately concerned about a kidnapping risk, that if people in the industry were able to identify the person attached to that wallet. So there are very unique nuances that come up in this space.
Yeah, when it comes to vendor due diligence, just at a really high level, who's doing what and how often, does it need to be done?
Sure. Yeah. So really there is an expectation that fund managers are diligencing all of their core service providers. So, think that means fund admins, that means your banks, that means your brokers, that means your legal, that means the software platforms that you might use. So any third-party vendor that touches sort of the core sensitive investor information, the SEC is going to expect you've done robust due diligence on those counterparties, both on an initial basis and an ongoing basis. So from the outset, you want to understand what are their cybersecurity and privacy practices. Are they able to protect the information that you're providing them with? That's really a big one. Obviously, SOC reports If it's your fund admin, for example, you want to make sure that they are actually conducting the appropriate AML KYC, taking the appropriate AML KYC steps when they're onboarding investors into your fund, both initially and on an ongoing basis. That's often an area where we sort of see advisors and fund admins sort of point at each other in terms of who has the responsibility for that task. So that's something that you'll want to keep up with in terms of your due diligence with your fund admin. And you want to make sure that it's not really a one and done, that you're able to demonstrate that you're continually evaluating these third parties on an ongoing basis. If it's a relatively low risk profile, it can be once, maybe it can be twice, for example. So it doesn't have to be every week or anything like that, but you want to show that you're able to demonstrate why this is a good vendor to work with on an ongoing basis, especially when they've got access to really sensitive information. And sometimes I think that's worth trying to implement a notice provision to the contract renewals, because sometimes that can just happen automatically and then you don't even realize another year has passed. And so you forget to do your DD, your refreshed DD. So I would try and have a notice provision that basically tips you off. Okay, time to renew my vendor due diligence again with this particular vendor as our contract is now renewing.
Yeah, that's really great insight there, Jenna. And I guess you mentioned AML, KYC, obviously. With crypto, it can be a little more technical, but is that more, obviously the admin can do it, it's got to be done. Can we kind of go into that process and talk about maybe as an ongoing monitoring process? Because there's kind of a lot of different ways people think about AML and KYC. I'm just curious.
Totally. And so, registered investment advisors don't have specific rules that apply to them yet regarding AML and KYC. There is a proposed rule out there that would subject RIAs to similar AML rules as broker-dealers and banks, which would be a lot more robust. But still, you really want to make sure that you have a framework in place as a registered investment advisor. And everybody's subject to not doing business with anybody that's on the OFAC list, which is a list that the Treasury Department puts out of specially designated nationals and blocked persons that no U.S. person can do business with. So that can be people, that can be entities, and that can now include digital wallets. And that sort of all came about. BitGo and Kraken and BitPay have had run-ins with OFAC mainly because they involving users using their platform from sanctioned jurisdictions. But I think Tornado Cash, I think it was in 2022, sort of really changed things a bit because Tornado Cash and its related wallets were actually placed on the OFAC list. So nobody could do business with those wallets. So, basically, what does this mean for RIAs? You really want to develop a counterparty screening policy that addresses sort of what procedures you follow depending on who you're transacting with. So, for example, if it's a centralized exchange, you can generally rely on centralized exchanges to have conducted, KYC before they've onboarded their users and they're permitted to trade. So you can reasonably rely on their controls. But again, as we know, not all exchanges are, created equally. So you still should do your due diligence on these exchanges. But I think when we're talking about decentralized exchanges, that comes obviously with a little bit more of a risk of transacting with sanctioned addresses that are sort of part of their unique liquidity pools. So since all of the addresses are publicly available on the blockchain, there are tools out there which basically allow you to understand sort of what the toxicity level is of that liquidity pool. So how many sanctioned wallets have been operating within that pool? And that can help you as the advisor understand whether or not this is an appropriate counterparty for you to transact with from an AML/KYC perspective. And maybe as a CCO, you keep a running list of sanctioned wallets from the OFAC list that everybody has to check before they, do some sort of a transaction, both on behalf of the fund, but also don't forget on behalf of the employees who are personally trading with other wallets as well. It's a strict liability enforcement scenario. So that's something that you really want to keep in mind. But, I think OFAC issued guidance a couple of years ago that really highlighted sort of the fundamental things that really help in terms of risk mitigation. And I think of that as sort of like a commitment by a senior management or a culture of compliance commitment, risk assessment, having policies and procedures in place, uh, testing and training. Do your employees know what the red flags are in terms of money laundering, for example? So having a fulsome policy in place, and again, having sort of procedures in place depending on what type of counterparty you interact with is vital. Mixers like Tornado Cash, as far as I understand, are pretty opaque in nature. So I think it gives advisors pause. Are these the types of counterparties that are really appropriate for us to be interacting with based on the AML protocols that the SEC would expect of
Yeah,
us?
yeah, those are really good points. And yeah, and obviously going back to your due diligence conversation or vendor due diligence, as you mentioned, and this is important too. Just I'm sure you can agree with this, but when you do diligence vendor, like an administrator, for example, that is going to do your AML KYC process, making sure they are using technology tools to do wallet screening and monitoring, not just a typical world check or FinCEN check, OPEC check that they usually do for any other
Mhm.
type of non-crypto fund, right? Doing that due diligence
Right.
process on them as a vendor, that they're actually taking care of it, as you mentioned, as they should. So that's definitely important.
Definitely. That's a great point. And maybe, getting a letter from them every year that basically says, yes, we are doing all of these things that we have outlined in our agreement that we'll do in terms of onboarding and continually monitoring the investors and the wallets.
Yeah, that makes a lot of sense. With when it comes to execution, let's transition a little bit into exchanges.
Sure.
Obviously, here in the U.S., there's a lot of exchanges that aren't allowed. I'm sure it's cases like that all around the world. But kind of how do you think about exchanges, and are there limitations when it comes to things like exchanges that you could use and whatnot?
Yeah, that's a great question because again, I feel like this is sort of this traditional concept, best X concept trading that we're trying to apply to this new asset class and new way of doing things. So again, advisors have a duty to obtain best X for client securities transactions, and this often includes, price, timeliness, responsiveness, financial resources, etc. So again, going back to whether or not cryptocurrencies are securities has still not been established, but still even crypto advisors should still seek to obtain or at least consider best steps when transacting in crypto. So I think of it for centralized exchanges and decentralized exchanges. So for centralized exchanges, you're looking at how is that particular cryptocurrency being traded. This involves comparing prices across different exchanges, considering different factors like liquidity, transaction costs, reliability of the exchange. So those are the different sort of qualitative and quantitative factors that you want to demonstrate that you are reviewing. If you're transacting on decentralized exchanges, again, we go back to that concept of the toxicity of the liquidity pool. Is this a decentralized exchange that is best for my client to be operating in? And then I think the other major consideration when it comes to decentralized exchanges are gas fees. So that's sort of how I would divvy up the different types of things that an advisor can evaluate when trying to apply best decks to crypto, both in a centralized and decentralized exchange format.
When it comes to like toxicity of liquidity pools, are there tools to assess these? I mean, how kind of in depth should a manager be thinking about this kind of stuff, and top of mind kind of thing, or how do you look at it?
I think when they're evaluating a new pool with which to operate within, that is something that should be taken into account because again, you don't want to get caught up in a scandal or transacting with a wallet that is sanctioned because again, going back to that strict liability theme. But there are tools and technologies out there, from different companies that can help advisors sort of evaluate that risk and measure the toxicity. So I think there are a lot of great tools out there that advisors can use and that the SEC would, appreciate seeing that the advisor is devoting resources to ensuring that they're doing the best that they can to sort of monitor this type of risk.
Yeah, absolutely. Let's maybe switch gears a little bit and talk about what disclosures relative to the ADV, what's required, what the different aspects of what needs to be disclosed. Maybe it'd be helpful.
Sure, definitely. That's a great question because again, when we think of disclosures for registered investment advisors, we really think of the Form ADV. Part one, which is really sort of a more numerical type of overlay as to what the business is, and then Part 2A is more of a narrative format that goes into your different investment strategy, different types of clients, et cetera, but a much more longer, robust written narrative sort of explaining everything. But these are publicly available documents. So they're regulator facing, they're client facing, investor facing, everybody can see them. So it's really important that your disclosures are buttoned up because again, investor protection and making sure that what the advisor puts out there is not false or misleading is of the utmost importance to the SEC. So before they even come in to your shop, they'll probably already have looked at your ADV online to see if they can find some deficiencies in your document or, little nooks and crannies that they're going to want to look at when they come in-house. So again, sort of there are unique risks to the crypto and digital asset space that I don't think traditional fund managers have had to deal with before or have to put into their disclosures. So, for example, high volatility. Obviously, token prices can be highly volatile, especially compared to traditional assets. And digital assets are highly speculative, and the SEC really does take a rigorous approach with respect to investor protection. So sometimes even a separate risk factor on the highly volatile nature of the digital asset market is a good one to have as a standalone. As we talked about, self-custody and private keys, theft, loss, destruction, etc., is really irreversible for the most part and could result in total loss of capital for an investor or at least very significant loss. So that's a distinct risk factor that would be advisable to call out. The availability of banking services. Banks could potentially cut off banking services to digital asset related businesses, which could negatively impact the price of an asset and drive down investments and result in investor loss. Even stable coins, if you hold stable coins and let's say the CFTC or the SEC sort of recategorizes stable coins and brings them more into the regulated bucket, do you have to sell those off? Well, that poses significant risk for loss to clients. Even if you don't hold stable coins, a large portion of the digital asset market still depends on stable coins. And so let's say there's a run or there's a depegging or there's a change in the regulatory status of stable coins, that could lead to dramatic market volatility too. So we often see that called out as a specific risk factor. And then I think, again, similarly, having a risk factor for future regulatory change is a good one. Obviously, we're still waiting for more transparent guidance to come out of our regulatory bodies, and we're in the very early stages of regulation, and future regulatory developments, enforcements, et cetera, can really impact how certain digital assets are classified, particularly as securities or commodities. And again, this could result in advisors having to take on significantly more expense with regard to whether or not they have to register in a way that wasn't contemplated before, or if they have to liquidate a large number of assets depending on how those are categorized by our regulatory agencies. So sort of both of those scenarios could result in significant expense or loss to investors. So those are some of the key ones that we typically see called.
Yeah, those are a great example, Jen. I think obviously the banking one, we all lived through that unforeseen change and impact into the service providers that were utilizing certain banks versus others, right? So that definitely makes a lot of sense.
Which caused a lot of SEC outreach to investment advisors to see sort of what their exposure was, even though it wasn't a formal exam. So, again, these things prompt regulatory inquiry and interaction.
Yeah,
definitely. Yeah. With working with fund managers that need help kind of navigating this landscape of compliance or regulatory, disclosure. Some fund managers have launched funds before in the traditional space. Some are new to the space, have no knowledge or background into what needs to happen with AML, KYC, all these things. They're just into crypto. I'm curious your lens on what you see, maybe what they're missing when they start out, and what you have to advise them. Maybe common things, or maybe some things that are maybe not so common for the fund manager, thinking that this was not a big deal, and that it is, right? So I'm just curious your experience in some of those different examples, if you had any to share.
I think a lot of times the struggle for new managers, whether they're traditional or whether they're crypto, is not having an off-the-shelf compliance manual and code of ethics, policies and procedures framework. The SEC really expects that the procedures that an advisor implements and operates within are very bespoke to them, their size, their strategy, their employee size, for example, their different office locations. They really, really expect it to be tailored to your business. That's one of the biggest things that we sort of have to drill down into the nitty gritty with newly registered advisors. And is, okay, well, we can put this really pretty compliance manual in place for you, but if there's no practical way for you to demonstrate and document that you are actually following these policies and procedures that we've put in place, that looks really bad, actually. And it's better not to have those policies and procedures at all. So I think really it's developing those tailored policies, making sure that there are practical ways that the advisor and the employees can keep up with those policies. And again, having that documentation that you are following those policies and procedures, because I think a lot of, especially existing clients that we work with, they have really good elements in place, but if you're not documenting them, you basically aren't getting any credit for the good work that you are doing. So I think that's really important. And then from a disclosure standpoint, I think something that's often overlooked by many advisors, again, traditional or digital asset, but again, there's more nuance to digital asset, is ensuring that there's consistency across the different documents. So are your policies and procedures on best execution, for example, does it convey the same practice that's disclosed in your ADV Part 2A? And is that the same in the fund docs, that your investors are reading? So I think consistency is also very important across all of the documentation, especially that the investors are relying upon, and that the regulators are viewing as well.
That makes a lot of sense. And obviously, so the idea of taking a template off the shelf compliance manual or code of ethics it's not a good idea in any case. It needs to be customized and focused based on their specific strategy, their firm, and what they're looking to do. That sounds like it makes sense.
Definitely nailed it. Yeah.
Can you talk to us about some of the things that people should be thinking about when it comes to emails, social media, the works?
Electronic communications and using approved communication channels is a big thing for the SEC. And we've seen a number of enforcements come out of this with big fines. So nobody really wants this to happen. But per the SEC's books and records rule, all business related communications must be archived. So again, we think of email, we think of Teams, we think of different chats, and this is a bit more nuanced for the digital asset space because they're using sort of these newer mediums like Telegram and Slack, for example. And, I think a lot of these newer communication mediums have been integrated into the electronic communications archiving platforms, which is great, but that really is a huge focus area of the SEC, is that everybody's using their firm email, using the approved, Teams or Slack or Telegram or whatever it is, and that all of those things are being archived and reviewed. So people shouldn't be texting, people shouldn't be using social media, LinkedIn, Twitter, et cetera, to make communications with investors, for example. You fund managers obviously don't want to blow their Reg D exemption, by having an employee sort of rogue tweeting about the fund and then and blowing the general solicitation exemption, and that has all sorts of regulatory fallout to it. So it's really important to train employees on the different approved communication channels and why it's such a big deal not to use those. And sort of like the Form ADV, remembering that social media is not only investor facing, but also regulator facing. So the regulator could, do a Google search of all the different employees and see what their X activity is, or what they're doing on LinkedIn, or what they're doing on, whatever other platform before they even step foot into your shop. So it's really important to sort of have those good policies and procedures implemented, in a really important area that should be followed in practice, obviously, as well.
So, one question for you, Gena. I know the cybersecurity rules are coming down end of the year, as far as that, for all funds that have to abide by those rules, whatever they're going to kind of be adopted by year end. For digital assets specifically, where do you see the changes, the most impact for fund managers from your lens?
Yeah, that's a great question. Obviously, cyber has very much been sort of included into the compliance bucket and regulatory scrutiny of managers, both traditional and on the digital asset side. One interesting point that I've heard of recently was that's more focused for digital asset managers is apparently there is a new way to sort of spoof wallet addresses. So sort of like when you are using your credit card online and you X out the majority of the digits, but let's say you see the first four or the last four, credit card or social security number, whatever. Apparently there's a new, I don't know if it's a ransomware or what it is, but it's having the effect of spoofing wallet addresses by basically mimicking some portion of the digits so that it looks like the actual wallet. So things are getting sent, obviously, to the incorrect wallet via that spoof, which is a new one.
Wow.
So these things are obviously ever evolving and ever changing. So cybersecurity and sort of staying on top of the new different attacks that hit the digital asset crypto space is something to keep.
Yeah, that's great commentary there. It's obviously another layer that everybody has to keep track of, right? That wouldn't be innate from a traditional cyber policy for a fund that is non-crypto. So that's definitely a good point there.
Yeah. Gena, this has been awesome. Any final advice before we wrap this up for fund managers out there?
Well, have a good day one deck on hand so you don't panic when the regulators come a knocking, because they definitely will. And just try and go through this process ahead of time so that you're not surprised by anything during a live SEC exam. Would be sort of two takeaways that I would take for crypto managers to try and best prepare themselves.
Yeah, absolutely. Awesome. Well, Gena, this has been a lot of fun. I've learned a lot chatting with you here. Where could people go to connect with you and learn more about your company?
Oh, sure. Absolutely. Please visit the Salus GRC website or find me on LinkedIn or the firm on LinkedIn. Happy to connect and chat more.
That's awesome. This has been amazing, Gena. We'll make sure to include all that in the show notes.
Thank you so much.
Awesome. Thank you, Gena.
Thank you.